Hey everyone, this is Michael St. Clair with Freedom Equity Group, and today we're going to focus on the flex term with AIG, utilizing the rapid rater first, and then we're going to get into the QOL advantage and the term laddering. So first, come up here, we're going to select state, and in this case, we're going to go ahead and use California, gender, male or female client, and the age of your client, we're going to keep it at 45 today, and we're going to use $1,000,000 as our test case here. Now, the payment mode, how often do they want the premiums to be paid? You could pay it annual, semi-annual, quarterly, or monthly. Most cases, you're going to select monthly, and they're going to come down here and click submit, and it's going to give you every term duration possible. And there are 18 different term durations with the flex term, starting at a 10-year, then we have a 15-year and to 30-year, and then a 35-year term. So we're going to assume the client wants a 35-year term, longest coverage possible, covering them out to 80 years old. Now that would cost the client on a monthly basis of $250.42. Now let's say the client says, well, you know what, Michael, that's a little too expensive. Is there any way we could get it a little cheaper? Absolutely. So what are we going to do? We're going to utilize the QOL advantage. And how do you do that? You're going to come up and go to the E station at AIG. You're going to log in. You're going to scroll all the way down to the bottom. And then you're going to go to WinFlex. You're going to go start or view your cases. And a new window will pop up. And this is what it will look like. From this point forward, you're going to click illustrations. And then you're going to want to start a new case and select AIG Partners Group QOL. We're going to focus on the flex term, not the flex term advantage. That's not available, so we're only going to focus on the flex term. So make sure the top one is selected. Go ahead and click Create Client. And we're going to go ahead and fill in some client details here. Valued client, male. If you have the date of birth, you can go ahead and enter it if you'd like, or you could just simply type in the age. Class, what's their rating? You don't always want to overpromise and underdeliver. By that we mean overquote them. You don't want to give them a quote where you give them preferred plus just because it looks good on paper, because they still have to go through underwriting. But in this case, our client's in decent health. We're going to go ahead and use preferred. And we are in California, so we don't have to worry about anything there. Coming over to the software tab, got a couple choices. The main two that you're going to use are going to be the premium amount and the face amount. In this case, we're going to go with premium amount because we know how much face amount we need. We need to cover $1 million. But why would we use the QOL advantage to do this? Because most likely that $1 million that the client needs isn't really going to be a necessity for, 35 years. He may need only a portion of it for 35 years. So in this case, we're going to assume that the base policy here we're going to do is $250,000 on the base policy. And we're going to select that for 35 years. Now, policy options, this is where you're going to change your premium payment mode. We're going to switch that to monthly. And then getting into your discounts tab, this is actually where you're going to find the QOL advantage and how to add on the term laddering. And you can add up to 5 different term policies onto the base policy. So the first one we're going to look at here is we're going to do a $300,000 one. Let's say they just bought a home and they want to make sure if anything happens to the breadwinner that the house can be paid off. So we're really getting technical and customizing coverage. Even though it's just a term policy, we can customize the coverage by meeting their exact needs with each specific term duration period. So we're going to go ahead and select that for 30 years. And then we're going to add in another $150,000 for miscellaneous needs, and we'll say that's going to be for 20 years. And then we're going to also add in another $200,000. And that will be for 25 years. And then want to make sure the kiddos get through school just to be safe, and we'll add a 15-year term onto there. So we got additional coverage of $750,000 listed right here. And if you want to go back and make sure you have your base policy right, it is under the software tab. You'll see the base policy is $250,000. So combined coverage of $1 million. Now keep in mind, we were spending $250 a month for just standalone $1 million worth of coverage. Now that's not getting customized, that's just one policy. Now what are the benefits of having the QOL advantage? Well, each individual policies is exactly what that is. It's an individual policy. They're going to have the free ABRs on each of these policies as well. So it's not just going to be a rider that doesn't have any other benefits. They act as if they're a brand new policy. However, you're just getting a discount on them because you're banding them or combining them all at once in volume. So coming over here to the Riders tab, you're going to notice that the terminal illness, the chronic illness, and the critical illness are automatically selected. They're free on every policy that we sell over at AIG. So that's a great thing to have. Reports, really don't need to worry about too much on that part of it. We are just doing a basic term illustration. Agent info, make sure you want to type your information in here. And in this case, we are in California. And we're going to slide down over here to concept real quick. And we're going to switch this to term illustration because we want to see essentially the quotes up front. So after you have all that inputted, we're going to go ahead and click calculate. It should be pretty quick. And we're going to show the client the benefit and discount that we're going to be able to provide them by specifically meeting their needs in a more specific way, in a more detailed manner. Now, we're not going to be able to do this unless you do the financial needs analysis, which is a very, very important part of your client appointment. Without the financial needs analysis, we don't know really what we need to cover. So make sure you do the financial needs analysis so we can break down the coverage and get them something customized specifically for their needs. So after this pops up, this is going to give you a little summary. We're going to come over here to the illustrations. We're going to go ahead and click that PDF. And this is actually on the front side going to give us a snapshot of all of our policies that we just applied for. Now, technically, we're only going to go through one paramed, but it's going to be for multiple policies, essentially. And like I said, you can convert this. It's fully convertible for the entire term duration or up to the age of 70. And you can also do partial conversions as well. Now, when you do convert this, how would you like to take a non-cash value product like a term and be able to take up to 1 year of those premiums that you paid and apply that to the accumulation or the premium of a new permanent policy? You're able to do that with the flex term at AIG. So let's take a look at the base policy of the $250,000 for 35 years. It generally would cost us $72.01 a month, but we're going to give them a discount of $4.54. So now our discounted premium is $67.47. Scrolling down here to the next one, we have a 30-year term. Would have been $69.29, but because we bundled it, we got a $10 discount. So discounted premium now is going to be $58.65, and then $150,000 for 20 years. It's going to be $17.13, a discount of about $13. And then we have the $200,000. Would have been $57.52. However, we got a nice size discount, pretty much almost cut it in half. We got $24.48 coming off of that, so leaving us with a $33.04 monthly premium. And last but not least, we have the $100,000 to get the kiddos through school for a 15-year term, and that would have been $19.81. Instead, we discounted it by $11.42, making it $8.39. And the benefit of this, you're only paying one premium payment. You're not paying 5 or 6 different premium payments. It's actually all combined into one. So how much is that going to cost us now? Well, that same $1 million worth of coverage that we looked at that normally would have cost us $250 a month, we're actually going to pay $184.68 a month. We're going to save the client about $64.70 a month, a total savings of $776 a year. Just by doing one additional step, being a little bit more detail oriented and doing the financial needs analysis, we're able to customize this coverage. Even though it's term, even though it's simple, it's meeting all of their needs and all of their requirements at the end of the day. So what's another benefit of this? Well, let's take a look at it. You have a 15-year, a 25, a 20, and a 30-year term, and a 35-year term that all have ABRs on it. So essentially, you could pick whichever policy and whichever amount that you want to accelerate. And if you choose to, guess what? You're still left with your remaining other policies that you still have in force. Now, let's say that 15 years go by and nothing happens and no claims were filed. Well, your policy premiums are going to reduce by $8.39. And then after 20 years, it would reduce by $17.13. And after 25 years, it would reduce at $33.04. And after 30 years, it would reduce by $58.65, leaving us with the real base policy for 35 years and only costing us $67.47. Now, when you look at this over the lifetime of the policy, because we are looking at it on an annual basis here, we're going to go ahead and take this $776 that we're saving the client. So we're going to take 776.4 and we're going to times that by 35. We've saved the client $27,000 over the lifetime of 35 years. If we would have just stuck with an original standalone 35-year term, he would have been paying about $250 a month, but instead we became a detailed agent. We bundled the policies together. We saved the client $776 a year, but we saved them $27,000 at the end of the day. So with the AIG Flex term, it keeps it very, very basic. And let's say you wanted to come back and you wanted to change a couple things. Very easy to do. Simply come over here, select valued client again, and we're going to go back into the solve for box. Let's say we're going to take it a little bit lower, just do $100,000 on the base. So now reducing the coverage a little bit. It's very interactive, very easy to do, and we're definitely trying to do one thing: stay within the price point that the client has in mind. We went from essential $250 to $180 roughly a month. That's a big difference for $1 million worth of coverage, because technically day one, client would still have $1 million regardless. It's just, it's laddered. So we're going to give him a discount. So if anything, if he were to pass in the first, 5-10 years, guess what? There's still $1 million being transferred to their beneficiaries, no questions asked at the end of the day. So if we came back in, we changed the first base policy just down to $100,000, just to keep it simple. So we reduced it by about $150,000. In doing so, it took off about another $30 for us. $155 would be the amount now. So that's how easy it is to quote with the Rapid Rater. That's how easy it is to run a quote utilizing the QOL Advantage on the software.